There are a lot of issues out there for municipal fund investors. You have Puerto Rico, Detroit, Chicago, Illinois, all kinds of things that people are worried about. So investors who had been turning to these funds for tax-advantaged income are probably wondering whether or not they should stick with these funds for the long term.
As recent headlines suggest, some municipal bond funds may pose more risk than others, especially if the fund employs leverage. Morningstar analyst Cara Esser specializes in closed-end funds. She says about 25% of the closed-end fund market consists of muni funds, and almost all have, you guessed it, leverage.
There are only actually 4 unlevered municipal closed-end funds. So the difference between a leveraged municipal closed-end fund and an unleveraged fund is obviously the use of leverage. So they tend to be a lot riskier. The share price and the net asset value will move around a lot faster and much more quickly than an unlevered fund. And you'll also find that distribution rates are higher in a lot of the levered muni funds, and also they tend to take on a little bit more risk when it comes to duration or credit.
What exactly is leverage? In the case of municipal bond closed-end funds, leverage typically involves the issuance of preferred shares.
Almost all municipal closed-end funds that are leveraged use preferred shares to create that leverage. The preferred shares can be sold to the public. They can also be privately placed. And there are 2 main types of preferred share leverage, fixed rate and variable rate, though there are a lot of different subtypes within those. So fixed rate, it comes out with a set dividend payment that is made every month to the shareholders of the preferred shares, and the variable rate will change based on market interest rates.
Taking on more risk is part of the bargain when you invest in a leveraged fund, but how much additional risk depends on several factors.
And the first would be the amount of leverage. If you had the exact same fund that one was levered and one wasn't levered, then the difference in volatility would be on par with the amount of leverage that the fund is using. However, you have to take into account that funds are using different strategies, they're taking different amounts of credit risk, they're taking different amounts of duration risk. So there are a lot of underlying factors, but at the end of the day, your levered municipal closed-end fund will be more risky and more volatile than an unlevered municipal closed-end fund.
Another consideration may be a potential onset of what Esser calls market jitters.
Especially if you're looking at a leveraged municipal fund, while you're getting a good benefit of additional tax-advantaged income from the fund, you also are looking at a big risk here when it comes to investors running away from the fund because they're scared. A lot of retail investors tend to invest in municipal funds, so any kind of market jitters tend to translate into a lot of investors running away from funds, which can negatively affect the share price of a closed-end fund.
Cara Esser of Morningstar sharing a perspective on leveraged municipal closed-end funds. For more information and data on closed-end funds, visit our sponsor, CEFconnect.com, the authority on closed-end funds. Thanks for watching. This is Closed-End Fund News.